When most people purchase life insurance policies, the primary objective behind it is to ensure that their family is taken care of in the event they are not around to do that themselves. It's a way for them to provide the financial support required so that their family can maintain their lifestyle as they have been for the last few years. It takes into consideration all the major expenditure that the breadwinners in the family can provide for. But what happens when a couple gets divorced? Is there a need to provide for ex-spouses? Is there still a need to provide for children in the family? And this would vary from case to case. What I'm going to do today is share with you 2 case studies and 2 examples of different situations where I've seen clients go through divorces and how they use their life insurance policies and how they altered the use of their life insurance policies. In our first case study, both spouses in the household are income earning members, and they both roughly earn about the same level of income. They both contribute evenly towards education planning for the children, towards their own retirement, towards taking care of all the liabilities, which includes some of the car loans as well as the credit card debt that they have currently. At the end of the month, when they're done with their expenditure, they have about 15% available as a surplus that's there for their savings. Both these family members have got life insurance policies in place. And as it stands right now, their life insurance policies have each other as primary beneficiaries, and their children are named as contingent beneficiaries. About 10 years into the marriage, the couple decided to split up and file for divorce. While this was an amicable divorce, their finances took a real hit. Both the spouses had an equal income. However, by the verdict of the court, the wife was to receive an alimony that would take care of all her monthly expenditure and the expenditure for the household. The couple, however, decided that it was more favorable to both of them if instead of receiving a monthly alimony, that the payment was made as one large chunk. Added to that, they also took care of the monthly expenditure with regards to the children's education and maintenance. Now here's where their finances got more challenging. After the divorce, they lived in 2 separate households. The father had to take up a separate apartment of his own, while the mother and the children continued to stay in the old family house. This meant 2 sets of rental bills, 2 sets of utilities, and a bunch of other things that still continued as is, which meant education planning for the children, the life insurance policies, the retirement plans, and everything else still had to be paid. Post-divorce, the parents continued to fund the education plans for the children, the retirement plans, as well as their own life insurance policies. While the education policies remained as is, the retirement plans were now split up into 2 plans, one taking care of each of the spouse. These plans were funded by themselves. I guess the biggest change to the structure of the life insurance policies came more around the beneficiary nominations. While in their previous arrangement, they were both beneficiaries on each other's policies, while the children were contingent beneficiaries, in the new arrangement, the children became primary beneficiaries, and they also named other family members to be contingent beneficiaries on their own life insurance policies. While there was a huge lump sum that was paid up front as part of the alimony, there is still a need for a fairly large valued life insurance policy on the father because he still has obligations towards funding the education cost of his children. And if something were to happen to him along the way, then that education still needs to be secured, or the cost of that education still needs to be secured. The need for life insurance is also as great on the mother simply because she has now become the primary caregiver. And if something were to happen to her, then the dependency of the children on her or on the activities that she actually took care of for them would be so much greater. The need for change in beneficiaries is as important as neither of the spouses would want each other as beneficiaries on the policy. But their primary concern today would be the upkeep of their children. Let's look at the second case study. In my second case study, we have only one breadwinner, and that's the father. He's a businessman, he runs a successful business, and he is responsible completely for the financial well-being of his family. The father has a large valued life insurance policy with his wife and children as the beneficiaries, and if anything were to happen to him, then the payout would be made in a manner that his wife and children would continue to live the same lifestyle as they're accustomed to right now. The couple, however, a couple of years down the line, filed for divorce, and as part of the settlement of the alimony, would receive regular expenditure taken care of by the father. In the event the father were to die now, A lump sum of money would be payable as part of the life insurance proceeds to his ex-wife to ensure that she can continue to maintain the lifestyle of herself and her children in the same manner as what they were accustomed to in the past. The case for large value life insurance coverage on the father remains as is. However, now there is a case to be made for life insurance on the life of the mother. And the reason for that is, if something were to happen to her today, someone would need to pick up after her to ensure that the duties and responsibilities of a homemaker and a caregiver to her children continue as is. This might mean that the father might need to recruit the services of a nanny, or he might have to spend lesser time in the business and more time on the children. Either way, this would result in a loss of income. And that loss of income could be made up by purchasing the right valued life insurance policy on the mother. Let's talk about how the beneficiaries on this policy would be structured. The payer of this policy would be the father. The beneficiary of the policy could also be the father or a trust. The tenure of this life insurance policy might be roughly equal to the point in time where the children are now independent. Every divorce settlement will have its own set of challenges. The emphasis for a need for life insurance on both parties thereafter is greater, as the parents may not have each other to fall back onto. The purpose behind a life insurance policy is to ensure that the families don't have to suffer financially in the event one parent was not around.